This is a topic very close to my heart and my wallet, given that I've made a career out of investing in UK smaller companies. And just to prove that I've got the credibility to speak to you this morning, a little bit of background, a little bit on Amati. We're a specialist investment house. Smaller companies is all that we do. We're based in Edinburgh. We run basically two types of products. Our core product is a venture capital trust, which invests mainly in companies listed on the alternative investment market, AIM. But we also run a more mainstream, traditional, smaller companies fund, which invests from AIM all the way up to mid-cap sized companies in the UK. Not allowed to market. All I will say is that we've been doing this for quite a long time. We've won a few awards along the way. So moving swiftly on. You've heard from the first speaker this morning about the importance of checklists when you're looking at companies. And I suppose my role here is to put a bit more meat on the bones of that, to give you a few company examples, to give you the benefit of my experience at the coalface with smaller companies and the grey hairs that that's generated over the years, and to convert that checklist into what you should be looking for as a stock picking list. Now, our wish list at Amati for the sort of companies we're interested in isn't really rocket science, and to be honest, none of it is. It's all very sensible and solid stuff about what you should be looking for in the quality within companies. The key thing is to try and get as many ticks in these boxes as you possibly can. And that's the nature of smaller companies. You're not going to be offered the off-the-shelf mature version that you get with larger caps. There will be gaps in this list, and you have to bridge those gaps as best you can. You can never entirely remove the risks, but that's also what makes the task more interesting and more exciting. So what are these ticks then? Well, they are the usual basic stuff of must-haves of a company that's able to grow its revenue and profits with good visibility. Now, that visibility is likely to be built on some form of protective barrier to entry to keep the competition away. That might be proprietary intellectual property. It might be a particular competitive advantage that the company has with its product or service. And that visibility should be helped along the way, clearly, by a very good management team and also access to sufficient capital to allow the company to keep growing. You may also, if you're lucky, be helped along the way by some bid interest in the company if it's got a trade value potential. Sometimes, not very often, but sometimes you'll get most of these ticks all wrapped up in a nice neat package with a very cheap ribbon. It doesn't happen very often, but when it does, it's the closest thing you're going to get to a free fiver. I'll give you an example of a couple of things we've had in Amati that we could call a free fiver. The first is a company called Sprue Aegis, which is AIM listed. You may or may not have heard of Sprue Aegis. I suggest you take a trip to your local B&Q where you'll see their home safety products stocked on the shelves. It's a company with very strong intellectual property. For a small company, very big market share. And unusually for smaller companies, it's got surplus cash. We held an investment in Sprue Aegis for many years whilst it was listed on the Plus and ISDX markets. On those markets, it grew very steadily and actually attracted a bid not so long ago from a trade investor who was already in the company at 90p when the share price was 63p. This bid, as you'd expect, was duly rejected by ourselves and the other institutions who were invested in the company, given that it represented a very low price-earnings ratio and a very high dividend yield. And we recommended to the company that they moved onto the AIM market. Basically, Sprue Aegis was completely off the radar for mainstream investors. Thankfully, they took our recommendation, moved on to AIM. We took more stock on the flotation at 200p, and with that wider investor awareness, the shares motored on. And I'm pleased to say that in just over a year, the share price has quadrupled from the level we were looking at previously. Now, just to prove that that wasn't a complete fluke, Another example of a free fiver in the portfolio is STV, which is the Scottish TV broadcaster. This is a fully listed small cap company, just to prove that free fivers aren't restricted only to micro caps. So it was a very well known company. When we looked at it, the valuation again was very, very attractive. A sub 7 times profit multiple, albeit no dividend being paid. And the reason for the discount valuation was essentially some concerns about the renewal of the TV license. This has been renewed out to 2024, but the key thing for us was that last point on the second bullet. FCF stands for free cash flow. What does that mean? Well, that's the amount of cash that a company has left in the piggy bank after it's reinvested in its own growth. That figure of 20%, which is that free cash flow as a percentage of the valuation of the company, is an extraordinarily high figure. Most companies will struggle to achieve a third or a quarter of that sort of free cash flow yield. Some companies don't generate any free cash flow at all. Now, as the earlier speaker indicated, if you've got cash, you can do things with it. We had the benefit over last year of the tailwind to the earnings from the World Cup. There was also bid speculation surrounding its much larger peer ITV. So all of that helped with the share price, but essentially STV got busy with that free cash flow. And where we sit today, they have a dividend yield of 2% going into 2015. They've paid down about 30% of the debt, and they've put an injection into their pension fund. There was a pension fund deficit that affected the rating as well. So in a relatively short order, we've had a 90% uplift in the share price. So okay, free fivers are the easy ones to spot. As VCT managers, we don't always get things presented to us as easily and neatly as that. We see a range of companies on a daily basis, some of them from very, very early conceptual stages. And I'm going to run through the more likely types of companies that we get confronted with. At the earliest stage end of the spectrum, you might have what we would call the pie in the sky companies. These are situations where companies might be involved in some leading edge scientific research. They may be in preclinical trialing of drug development, or they may have frontier natural resources in mining, oil and gas, renewable energy or whatever. And at the point at which they come to talk to us, it's more or less an idea, and their message is, trust us, it's the best thing you'll ever see. Unfortunately, the development of that idea into a finished product or service can take a very long time and cost a lot of money. So we don't do very many of these, but one we did is a company called Fox Marble. Now this was effectively a startup company when they came to talk to us, but a startup company with a difference. They had marble deposits in the ground, which they are now producing and selling. They actually have some of the last undeveloped world-class marble deposits anywhere in the world, at the moment in Kosovo and Macedonia. And what our job then was to allow those marble deposits to be mined and for the company to approach commercialization. Because of its early stage nature and the fact that we were investing as a private company before it came to AIM, one of our team, Paul Jordan, sits on the board as a non-executive director so that we can keep an eye on developments. The next proposition we might see is what you could call the best thing since sliced bread. Now we've moved the story on from the pie in the sky vision to companies that actually have a product and they're approaching adoption of that product or service in the market. And we're there to actually accelerate the commercialization of that. This is really meat and drink for the sort of things we look at, because you have a product which you can then assess from an intellectual property point of view or a competitive advantage point of view, and you may be able to use third-party technical expertise to give a verification of that intellectual property. An example of this is a company called Hardide. Now, many, many years ago, Hardide developed a chemical process for depositing tungsten carbide onto steel. What that creates is super hard coatings that increase the useful life of metal components that are used in very hostile environments, such as oil and gas drilling or aerospace applications. The coating saves downtime on wear and tear and obviously saves money. Now, the point at which we got involved was some way down the line from the initial concept, and I'm pleased to say that the turnover for this company is now building very nicely. It has hit a profit last year. It's not profitable on a consistent basis, but it's much further down the line than the pie in the sky type. You might also be interested to know that the first time we spoke to Sprue Aegis, it was a company like this. It was a Best Things Since Sliced Bread smoke alarm that they brought in to present to us. And that 10-year timescale tells you something about how long it actually takes to get these companies to the next stage. Moving down the maturity spectrum, we can also then see companies that have a product or a service that's already in the market, is selling, and we can assess whether this is a better, faster, cheaper version of what's already there. An example of that is a company called GB. GB is a software company which specializes in identity intelligence services. Now, what the heck is that? Well, basically it gathers data from a variety of sources, which it then aggregates and sells to its clients, which allows them to do a range of identity checks. Now, this may be background checking on individuals, it could be fraud checks, it could be credit checks, it could be criminal records checking. All this data was available already in the marketplace, but what GB has done is bring it all together and speed up the process of screening. One example is that the Football Association used GB to screen all their coaches for criminal records prior to appointing them. Next in the evolutionary scale is what you might term rollouts. These are typically the rollout of retail or leisure brands where a successful concept or format can be replicated on successive sites right across the country. We own a company called Prezzo, which hopefully might be familiar to you. It's an Italian restaurant operator with more than 200 sites spread across the UK, and it's run by very, very experienced management, which was the key reason why we got involved. We weren't taking a bet that on an untried and untested management team to roll the concept out. Another rolling out proposition is what you might term a roll-up rather than a roll-out. That's where companies launch themselves as an acquisition vehicle to enter a market and then acquire lots of the competition and scale up a business. We're less keen on those sort of rolling propositions. There's a good deal of execution risk involved in putting all the businesses together, and many try a roll-up concept, but very few actually succeed at it. The risks along the way tend to win out. Next on the evolutionary scale, we'd have what we would term hand-me-downs. Now, these are companies, I suppose, approaching the top end of our investment universe into large caps, which are already very mature, very well formed, and have been listed for a while. They will have ticks in pretty much all the boxes that we looked at earlier. They may have passed through private equity ownership on the way to coming to listing. So they're very well-established companies. So that's great. You get lots of ticks in the box, but the downside is that they don't come very cheap. They're already well-researched, well-owned, and the seller normally wants a pretty good price to sell it to us. We do, however, get involved in certain companies in specific situations. An example of that is the house builder Crest Nicholson, which had pretty much a near-death experience during the credit crunch, was taken private by private equity and then refloated back on the stock market when the private equity owners wanted an exit. As a consequence, because of its cyclical risks and downside experience, it came as a very attractive price, but it also had a very well written down land bank as a consequence of its private ownership, which meant that the profitability when it became a quoted company was substantially higher and its margins higher than its peer group. We also invested just after the company launched the Help to Buy stimulus, which actually transformed a pretty moribund UK housing market. So we will get involved in the hand-me-downs on a selective basis. The final category to mention is that we get presented with a lot of Me Too companies. I'm sure you've heard of them. They come along and say they're the next eBay or the next ASOS or the next Next. There's loads of them around. These are very dangerous companies. basically copying someone else's business success in the hope that the valuation of your business will match theirs is not really a recipe for success. We don't do these, not knowingly anyway, and we keep a weather eye on whether any of the companies in our portfolio become Me Too companies after a while. To go back then to our checklists, the flip side of the positives are the negatives. And it's a pretty fundamental fact that your success as a stock picker won't just be about the good stocks you pick. It will be about the bad ones that you screen out, the ones you avoid. And I think you should have, as the earlier speaker said, pretty rigid rules about the sort of things that you're looking for to avoid. I'm not going to go through these in detail, but the key no-nos for us would be companies that chase revenue growth, but they don't actually generate profits or cash, much like the earlier speaker was saying. There's an old saying that revenues are vanity, profit margins are sanity, but cash is king, and that's a very evergreen rule. The definition of business success is actually about cash flow generation. Also, watch out for companies that have aggressive accounting policies, particularly where it involves them recognizing revenues earlier than might be prudent, or hiding costs in the balance sheet, taking them out of the P&L account to make themselves look more profitable. Remember that, because we're going to come back to that in a moment with an example. Also be aware of companies that build their growth entirely on acquisitions rather than steady organic success. It's the old tortoise and hare analogy. Companies that explode with growth tend to explode. Also watch out for repeated fundraisings, companies coming back for money again and again and again, or growing mountains of debt in the process. Profits eventually have to turn into cash, and that cash is what allows the company to reinvest organically and keep growing. There's no point in them being dependent on you giving them the money to keep growing. Finally, be very, very wary of much-loved and fashion stocks. This is pretty much in the Me Too camp that I spoke about before. These can be wolves in sheep's clothing. So an example of a bad company, well, one which has the dubious honour of getting ticks in just about all the boxes. You may or may not remember this company. It's a nursing recruitment agency. It was founded in 2003 and floated on AIM in 2005 at 55p. So that's a pretty rapid success for something that was only founded 2 years ago. That success was mirrored in the fact that in 2008 it was the winner of the AIM Entrepreneur of the Year award. In 2009, the winner of the Growth Company Investor Entrepreneur of the Year. So lots of accolades, and it was a much loved stock on AIM at that point. Unfortunately, that's where the good news stops. Very soon afterwards, in 2010, it restated its accounts. It had been recognizing revenue earlier than it should have. Basically, its appointments, it was recognizing the revenue from those placings at the point at which someone accepted the post, nursing post, rather than when they actually started work. So there was an acceleration of revenue that had to be unwound. They were also capitalizing software costs, taking the costs out of the P&L account, putting them in the balance sheet and not depreciating them. So that's pretty much two big no-nos. That same year, they did a 78 million Australian acquisition. So it was debt funded, so you're compounding risk on top of risk. They're going into an overseas market. They're not raising any equity for this and funding it from debt. In management's words, it created the biggest healthcare staffing company in the world. This is an AIM-listed company taking on the world. The shares hit 287p and a lot of froth. Unfortunately, debt hit 130 million against a market cap of 325. It gets worse. In 2011, the shares were suspended at 112p. The founder and the CFO were dismissed for accounting irregularities. There was a £64 million rescue refinancing at 10p. There was a combined debt for equity swap and write-off of 30 million. And at that point, the company's cash flow was less than its interest costs. So much for cash going into the growth of the business. It was paying for the debt that had been built up over these deals. And it has a very sorry end from terms of shareholder value point of view. In 2013, the shares were taken private at 3/4 of a penny. So in that time scale, that's a pretty major destruction of shareholder value, and there's lessons to be learned from that. If you allow me to finish with a bit of a fund manager message, show of hands at the beginning, we all enjoy stock picking. You wouldn't be here otherwise, so why would you pay someone else to do it? A few points. Diversification. At Amati, we're a team of 3, and we're building and running portfolios on a balanced and diversified basis of about 60 maturing companies. Now, that's simply more than any one individual could cover. Access. Through our relationships, institutional contacts in the city, we get access to unquoted companies, which you may or may not get access to. We get access to the full range of new issues and placings. Good or bad, sometimes these things are not available to the general public. And we also have the flexibility to structure our investments between equity and convertible loans. Convertible loans provide additional income and downside protection as well when things get a bit stickier. Tax. Our VCTs are tax-driven vehicles. You get tax relief for investing in high-risk, high-growth companies on the alternative investment market. Your initial investment gets tax relief. The capital gains you generate get tax relief, and any income you get is tax protected as well. And lastly, why not consider a fund to sit alongside the DIY investing that you're already doing yourselves? It should be there to sort of complement the fun that you're having from doing it for yourself. And I have to say, with all of that comes the usual investment health warnings that we saw earlier. Investment can go down as well as up, etc., etc. So hopefully I've given you some food for thought this morning, and many thanks for coming along to listen.